At midnight Beijing time, China did something that will change the silver market forever. They locked the door. Effective immediately, silver exports from the People's Republic of China are banned. Not restricted, not taxed, banned. 0 ounces will leave Chinese borders until further notice. While you were sleeping, while Wall Street was closed, while the Western world was distracted by headlines about politics, and celebrities, the second largest economy on earth, just cornered the silver market, and nobody is talking about it. Welcome to Finance Currency. This is the most important video you will watch this year, because by the time the mainstream media picks up this story, it will already be too late. The price will have moved, the supply will be gone, and you will be left wondering why nobody told you sooner. Well, I'm telling you now. Before we go any further, I need you to do something. Hit that subscribe button right now, turn on notifications, because over the next few weeks, the silver market is going to move faster than anything we have seen in decades. And if you are not subscribed to Finance Currency, you are going to miss the updates that matter. Also, smash that like button. It tells YouTube that this information is valuable. It helps us reach more people who need to hear the truth before it is too late. Now let us get into what just happened. Here's the situation. China produces approximately 3,600 metric tons of refined silver per year. That makes them the third largest silver producer on the planet. But here's what most people do not understand. China is also the largest consumer of silver on Earth. They use more silver than they mine. They need silver for solar panels. They need silver for electronics. They need silver for electric vehicles. They need silver for their military. For years, China has been in a silver deficit. They have been importing silver from Mexico, from Peru, from Australia, from the United States. They have been draining Western vaults to feed their industrial machine. And now they have decided that not a single ounce of domestically produced silver will leave their shores. Think about what this means. If you are a Western refiner, you just lost access to Chinese silver. If you are an American solar panel manufacturer, you just lost a supplier. If you are a London vault operator, the flow of metal from the East just stopped. This is not a trade war. This is a resource war. And China just fired the first shot. The timing of this announcement is not an accident. It came at midnight. It came when Western markets were closed. It came during a holiday week when trading desks are running on skeleton crews. This is strategic. They wanted the news to spread slowly. They wanted the arbitrage bots to react before the human traders could. They wanted to create chaos, and chaos is exactly what we are about to see. Let me give you the context. For the last 3 years, we have been tracking the silver drain on Finance Currency. We showed you the flight manifests of planes leaving JFK and Heathrow loaded with silver bars heading to Shanghai. We showed you the LBMA vault reports showing inventory dropping month after month. We showed you the Shanghai premium, the gap between the Chinese price and the Western price, widening to historic levels. All of these signals were pointing to one conclusion. China is hoarding silver. They are preparing for something. They are stockpiling a strategic asset. And now we know why. They are cutting off supply to the West because they need every ounce for themselves. The official reason given by Beijing is national security. They cited concerns about critical mineral supply chains. They pointed to the solar industry, which requires massive amounts of silver for photovoltaic cells. They mentioned the electric vehicle sector, which uses silver in every battery connection. But the real reason goes deeper. China knows that silver is the most undervalued strategic metal on the planet. They know that the West is running out. They know that when the shortage becomes undeniable, the price will explode. And they want to be holding the metal when that happens. This is not speculation. This is game theory. This is exactly what China has done with rare earth elements for decades. In 2010, China restricted rare earth exports to Japan during a territorial dispute. The price of rare earths exploded overnight. Companies that depended on these materials were thrown into chaos. Japan had to scramble to find alternative supplies. It took them years to recover. Now imagine that same scenario, but with silver. Silver is in your phone. Silver is in your car. Silver is in your solar panels. Silver is in your medical equipment. Silver is in your weapon systems. If China restricts silver exports to the West, and they just did, the ripple effects will be enormous. Let us talk about the numbers. The world produces approximately 820 million ounces of silver per year from mining. Another 180 million ounces comes from recycling. Total supply is about 1 billion ounces. Demand is running at approximately 1.2 billion ounces. Do you see the problem? We're already in a 200 million ounce annual deficit. Now remove China from the supply equation. Their domestic production of 115 million ounces is now off the table for Western buyers. That 200 million ounce deficit just became a 315 million ounce deficit. There's not enough silver in the world to meet demand, and now there's even less. The COMEX, the main futures exchange in New York, has approximately 300 million ounces of silver in its vaults. But only about 30 million ounces are registered for delivery. That is the silver that is actually available to fulfill contracts. Think about that. We have 30 million ounces available, and we just lost access to 115 million ounces of annual supply. The math does not work. Something has to break. Either demand crashes, which would require a global recession, or price rises to ration the remaining supply. There is no third option. I want you to think about this from the perspective of an industrial buyer. You are the procurement manager for a major American solar company. Your job is to secure the silver needed to manufacture panels for the next 12 months. Last week, you had 3 potential suppliers in China. Today, you have 0. Your Chinese suppliers just called you and said, "Sorry, we cannot export anymore. Government orders." What do? You panic. You go into the spot market and you start buying whatever you can find. You pay any price. You call refiners in Mexico and offer them a premium. You call recyclers in Europe and beg them for supply. This is what is happening right now. While you are watching this video, procurement teams around the world are making frantic phone calls. They are realizing that the supply they were counting on no longer exists. And this brings us to the physical market. The disconnect between the paper price and the physical price is about to become a chasm. The COMEX can show whatever price it wants on the screen. But if you cannot actually buy silver at that price, the number is meaningless. It is a fantasy. It is a lie printed on a trading terminal. The truth is told by the dealers. The truth is told by the premiums. The truth is told by the words sold out on every major bullion website. Now let us go deeper. Let us understand why China made this move and why they made it now. To understand the present, we have to look at the past. China has been playing the long game with commodities for 30 years. They do not think in quarters like American CEOs. They think in decades. They think in centuries. Their strategy is simple. Accumulate hard assets while the West is distracted by paper wealth. In the 1990s, China began stockpiling copper. They bought mines. They bought refineries. They built strategic reserves. Everyone laughed. Why would they need so much copper? They were a developing country. Then China industrialized faster than anyone predicted. Their copper stockpiles gave them a massive advantage. They could build infrastructure at scale while the West struggled with supply constraints. They did the same thing with iron ore. They did the same thing with rare earths. They did the same thing with oil. Now they are doing it with silver. The difference is that silver is scarcer than all of these other commodities. There is less silver above ground than gold. Most people do not know this because it sounds impossible. Gold is the precious metal. Gold is the expensive one. How can there be less silver? The answer is simple. Silver gets used up. Gold sits in vaults. It gets made into jewelry. It gets passed down through generations. But silver goes into industrial applications where it cannot be recovered. The silver in your phone is measured in milligrams. It is not worth recovering, so it goes into the landfill. Billions of phones, billions of solar panels, billions of cars, all eating silver and never giving it back. China understands this. They have done the math. They know that at current consumption rates, the world will face a severe silver shortage within this decade. They are not waiting for the crisis to happen. They are positioning themselves to control the outcome. By banning exports, they ensure that their domestic industry has priority access to domestic silver. They force Western companies to compete for a shrinking pool of non-Chinese silver. They drive the price higher, which increases the value of their existing stockpiles. It is a brilliant strategy. And the West walked right into it. For 20 years, American companies outsourced their supply chains to China. They closed domestic mines because Chinese labor was cheaper. They shut down refineries because Chinese regulations were looser. They became dependent on a country that was never their ally. Now that dependency is being weaponized, China is not banning silver exports because they are angry at America. They are doing it because they can. They have the leverage. They have the metal. They have the power. And power in the world of commodities belongs to whoever controls the supply. Let me tell you about the Shanghai Futures Exchange. This is where China trades silver. For years, the price on the Shanghai Exchange has been higher than the price on the COMEX. Sometimes the gap is small, just a few cents. Sometimes it is massive, $5 or $10 per ounce. This gap is called the arbitrage spread. When the gap is large, traders can theoretically buy silver in New York and sell it in Shanghai for a profit. This is what has been draining Western vaults. Traders have been exploiting the spread. They buy cheap silver in the West, put it on an airplane, and sell it for more in the East. Simple. But now China has closed that door. The arbitrage is dead. You can still buy silver in New York, but you cannot sell it in Shanghai anymore because you cannot get it into China. What does this do to the price? It creates two separate markets, the Chinese market, which is closed to foreigners, and the Western market, which is now cut off from Chinese supply. The Chinese price will likely rise because domestic supply has to meet domestic demand with no help from imports. The Western price will rise even faster because we just lost a major source of metal. Both markets go up, but the Western market goes up more because our deficit just got worse. Now here is where it gets interesting. The COMEX price is determined by paper contracts. These are futures. They are promises to deliver silver at a future date. Most of these contracts are never settled with physical metal. They are rolled over or closed out for cash. This is how the banks suppress the price. They sell contracts for silver they do not have. They naked short the market. They create phantom supply on paper to push the price down. But this only works as long as people accept paper settlement. What happens when industrial buyers stop accepting paper? What happens when a solar panel company says, I do not want a cash settlement, I need actual metal? The system breaks. The paper market cannot deliver what it does not have. And with China removing 115 million ounces from the global supply, the paper market has even less to deliver. We are heading toward a disconnect. A moment when the paper price and the physical price diverge so dramatically that everyone sees the fraud. China's export ban accelerates this timeline. It brings the moment of truth closer. I have been saying on Finance Currency for months that the paper-silver market is a controlled demolition waiting to happen. China just lit the fuse. They know the Western financial system is built on paper promises. They know the COMEX is leveraged 100 to 1. They know that for every ounce of real silver, there are 100 ounces of paper claims. And they just made those paper claims even more worthless by removing real supply from the system. Think about it from China's perspective. Why would they send their silver to the West so it can be used to suppress the price? Every ounce of Chinese silver that goes to the COMEX becomes ammunition for the shorts. The banks use it to prove they can deliver. They use it to maintain the illusion of abundant supply. China is saying no more. Keep your paper games. We are keeping our metal. This is part of a larger trend called de-dollarization. China, Russia, and the BRICS nations are moving away from the US dollar as a reserve currency. They are tired of American financial sanctions. They are tired of the Federal Reserve printing money and exporting inflation to the world. They are tired of playing a game where America controls the rules. So they are building an alternative system, a system based on hard assets, a system based on commodities, a system where gold and silver and oil and copper are the foundation instead of paper promises. The silver export ban fits perfectly into this strategy. If BRICS announces a new trade settlement currency backed by commodities, silver could be part of that basket. By hoarding silver now, China ensures they have the reserves to back their new system. They are not just thinking about industrial demand. They are thinking about monetary demand. They are thinking about a world where silver is money again, and they want to own as much of it as possible before that transition happens. Let us bring this home. Let us talk about what is happening on the ground. What is happening at the coin shops? What is happening at the refineries? What is happening in the vaults? Because while the headlines focus on geopolitics, the physical silver market is telling a story that is even more alarming. I've received reports from dealers across the United States. The situation is critical. Inventory levels are at historic lows, not low like last year, low like never before. The major online dealers, the ones that normally have tens of thousands of ounces in stock, are showing sold out on product after product. Silver Eagles, gone. Canadian Maples, gone. Austrian Philharmonics, gone. Generic rounds, running out. 10-ounce bars, almost impossible to find. 100-ounce bars, delayed by weeks. And it is not just the United States. Dealers in Europe are reporting the same thing. Dealers in Australia are reporting the same thing. This is a global phenomenon. The retail market has been cleaned out. The public, the small buyers, the stackers, they got there first. They saw what was coming. They bought everything they could afford. Now there is nothing left for the latecomers. But here is what really matters. The refineries cannot restock. Normally, when dealer inventory gets low, they call the refineries and order more. The refineries melt silver bars and stamp them into coins and rounds. Supply is replenished within a few weeks. Not this time. The refineries are telling dealers they cannot fill orders. Why? Because they do not have the raw silver. The 1,000-ounce bars that refineries need to make retail products are not available. The wholesalers are sold out. The COMEX is not delivering. The London vaults are not releasing metal. This is the squeeze happening in real time. It is not a theory. It is not a prediction. It is a reality that you can verify by trying to buy silver right now. Go to any major dealer website. Look at the inventory. Look at the premiums. The premium is the amount you pay above the spot price. Normally, the premium on a Silver Eagle is $2 or $3. Right now, it is $15 to $20. On some products, the premium is higher than the spot price itself. This is the market screaming that the official price is fake. When premiums explode, it means physical supply is exhausted. It means buyers are willing to pay almost any price to get real metal. It means the paper market has lost control. The spot price can say whatever it wants. If you cannot buy silver at that price, the number is fiction. China's export ban will make this situation worse. The Western refineries were already struggling to source metal. Now one of their supply lines has been cut. The squeeze will intensify, the premiums will widen. The disconnect between paper and physical will become impossible to ignore. Let me explain how the supply chain actually works. Most people think silver goes straight from the mine to the coin shop. It does not. There are multiple steps. The mine produces ore. The ore goes to a concentrator. The concentrator sends it to a smelter. The smelter produces doré bars, which are impure. The doré goes to a refinery. The refinery produces 999 fine silver bars. These bars are usually 1,000 ounces. They go to wholesalers. The wholesalers sell to retail dealers. The dealers sell to you. At every step of this chain, there are bottlenecks. And right now, every bottleneck is clogged. The mines are not increasing production because they cannot. It takes years to open a new mine. The smelters are at capacity. The refineries are overwhelmed with demand. The wholesalers have no inventory. The dealers have empty shelves. China's export ban does not just remove Chinese silver from the system. It removes the pressure relief valve. When Western buyers could not find metal domestically, they could always tap China. That option no longer exists. Now, let us talk about the vaults. There are two main silver vaults that matter to the global market: the COMEX vaults in New York and the LBMA vaults in London. Together, they hold most of the investable silver in the Western world. The COMEX reports two categories of silver, eligible and registered. Eligible silver is in the vault, but not available for delivery. It belongs to investors who are storing it there. Registered silver is available for delivery against futures contracts. This is the silver that backs the paper market. Over the past 2 years, registered silver at the COMEX has collapsed. We went from over 100 million ounces to around 30 million ounces. That is a 70% decline. The metal is leaving. It is being withdrawn by investors who want physical possession. It is being shipped to Asia. It is being consumed by industrial users. And it is not being replaced. The London vaults tell a similar story. LBMA silver inventory has been declining steadily. Every month, there is less metal. Every month, the foundation of the paper market gets weaker. China's export ban accelerates this trend. Metal that was flowing from east to west will stop. Metal that might have replenished the COMEX will stay in Shanghai. The registered category could fall below 20 million ounces, below 10 million. And when it gets low enough, delivery failures become possible. A delivery failure is when someone stands for delivery of a futures contract, and the exchange cannot provide the metal. This has never happened on the COMEX, but it has never been this close to happening either. If a delivery failure occurs, the paper price becomes meaningless. The market reprices overnight. We are not talking about a 10% move. We are talking about a doubling, a tripling. The price would have to rise high enough to bring metal out of hiding, to convince current holders to sell, to ration their remaining supply among desperate buyers. That could mean $100 silver. It could mean $150. It could mean prices we cannot even imagine right now. I want to be clear about something. I'm not predicting a delivery failure this week, but China's export ban makes it more likely. Every policy that restricts supply increases the probability of a breaking point. We are stacking risks on top of risks. The deficit was already unsustainable. Now it is worse. The vaults were already draining. Now they will drain faster. The paper market was already fragile. Now it is more fragile. Something will break. The only question is when. Now we need to zoom out even further. We need to look at the big picture, because silver is not just a commodity, it is a monetary metal. It is a barometer of faith in the financial system. And right now, the financial system is showing cracks that cannot be papered over. The United States government is $36 trillion in debt. That number is so large, it is hard to comprehend. Let me put it in perspective. If you spent $1 per second, it would take you 31,000 years to spend $1 trillion. The U.S. government is $36 trillion in debt. The interest on that debt now exceeds $1 trillion per year. That is more than the defense budget. That is more than Medicare. It is the fastest growing expense on the federal ledger. And it is mathematically unsustainable. How does this connect to silver? Simple. When governments cannot pay their debts, they have two options: default or inflate. America will not default. We control the printing press. We will inflate. The Federal Reserve will create new dollars to buy treasury bonds. This is called monetizing the debt. It is the polite word for money printing. When the money supply expands, each dollar buys less. This is inflation. And when inflation runs hot, hard assets like silver rise in price to compensate. We saw a preview of this in 2020 and 2021. The Fed printed trillions of dollars to fund pandemic stimulus. Inflation hit 9%. Silver ran from $12 to $30. That was just a taste of what is coming. The next round of printing will be bigger. The next round of inflation will be worse. And the next rally in silver will make 2020 look like a warm-up. China knows this. They are not just banning silver exports because of industrial demand. They are banning exports because they see what is happening to the dollar. They do not want to trade their hard assets for America's paper. They want to keep the metal. They want to hold real wealth while the West drowns in debt. This is the fundamental insight. Silver is not just an investment. It is an escape hatch from a collapsing monetary system. Let me talk about the bond market. This is where the crisis is brewing. Bond yields are rising. That means bond prices are falling. When yields rise, it becomes more expensive for the government to borrow. It becomes more expensive for corporations to borrow. It becomes more expensive for homeowners to refinance. Rising yields break things. In 2023, rising yields broke Silicon Valley Bank. The bank held treasury bonds on its balance sheet. When yields spiked, those bonds lost value. The bank became insolvent. Depositors panicked. There was a bank run. The Fed had to step in with emergency lending facilities. They printed money to save the bank. They will do it again. Every time the bond market threatens to break, the Fed will print more money. This is the doom loop. Print money to save the system. Printing money causes inflation. Inflation causes yields to rise. Rising yields threaten to break the system. Print more money to save it. Repeat until the currency collapses. Silver is the hedge against this doom loop. Unlike bonds, silver has no counterparty risk. It cannot default. Unlike stocks, silver has intrinsic value. It is used in industry. It is used in medicine. It is used in technology. Unlike cash, silver cannot be printed by a central bank. Its supply is limited by geology. When the printing press runs hot, silver runs hotter. Now let me connect this to China. While the West is trapped in a debt spiral, China is building a parallel system. The BRICS nations are discussing a new trade settlement currency. This currency would be backed by commodities, not just gold. Commodities like oil, copper, rare earths, and potentially silver. If this currency launches, it changes everything. For the first time since 1971, there would be a major currency backed by hard assets. Think about what that means for silver. If silver becomes part of a monetary basket, central banks will need to hold it as reserves. Right now, central banks hold almost no silver. Their reserves are gold and foreign currencies. If BRICS requires silver reserves, there will be a wave of buying from institutions that currently own 0 ounces. This is not retail demand. This is sovereign demand. Governments buying silver to back their money. The quantities would be massive. The impact on price would be historic. China's export ban is preparation for this scenario. They are hoarding the metal that they will need to back their new system. They are denying that metal to their competitors. They are playing chess while the West plays checkers, and the pieces are being arranged for a checkmate. Here is something else to consider. China controls 80% of global rare earth processing. They have used that control as a weapon before. In 2010, they cut off Japan. The world scrambled to find alternatives. It took years. Now apply that same logic to silver. China does not produce 80% of the world's silver, but they are the largest consumer. They have the largest domestic demand. If they are willing to ban exports, they are signaling that domestic needs come first. Other countries mean nothing. Their own industrial machine matters. The West is on its own. This is the world we are entering. A world where resource nationalism is the norm. A world where countries hoard strategic materials instead of trading them freely. A world where access to commodities determines economic survival. In this world, the countries that own the mines win. The countries that have stockpiles win. The countries that hold physical metal win. The countries holding paper claims lose. America has very few silver mines. We produce about 25 million ounces per year domestically. We consume over 200 million ounces per year. We are 175 million ounces short every single year. We depend on imports from Mexico, Canada, Peru, and yes, until yesterday, China. Every one of those sources is vulnerable. Mexico is considering nationalization of mines. Peru has political instability. Canada is friendly but small. And now China has locked the door. You need to understand the vulnerability of your country. You need to understand that the silver you hold in your hand is more strategic than the politicians realize. They worry about oil. They worry about semiconductors. They do not think about silver, but silver is in everything, and there is not enough of it. So where does this leave you? What do you do with this information? Let me give you the battle plan for the weeks ahead. Let me show you how to position yourself for what is coming. Let me give you the tools to protect your wealth and potentially grow it in ways that most people will miss. First, understand that this is not a drill. China's export ban is real. The supply shock is real. The shortage is real. The price at this moment may not reflect reality, but it will. Markets can stay irrational longer than you can stay solvent, but they cannot stay irrational forever. Eventually, price discovers truth. And the truth is that there is not enough silver to meet demand. If you do not own physical silver, you need to acquire some immediately. I'm not saying bet your entire net worth. I am saying establish a position. Start with what you can afford to lose. 5% of your portfolio. 10%, whatever lets you sleep at night. But get some metal in your hands. Not paper silver, not an ETF. Physical metal that you can hold and store yourself. Why physical? Because paper silver is part of the system that is breaking. The ETFs hold silver in COMEX and LBMA vaults. Those are the vaults that are draining. If there is a delivery failure, the ETFs could be forced to settle in cash. You would get dollars, not metal. And the dollars you get would be worth far less than the metal you should have received. Physical silver has no counterparty risk. It does not depend on a bank staying solvent. It does not depend on an exchange fulfilling contracts. It sits in your safe and it waits. Now, about the premiums. Yes, premiums are high right now. Yes, you will pay more than spot to acquire physical silver. Do not let this stop you. The premium is the cost of reality. It is the cost of actually getting metal when metal is scarce. In 6 months, you will not care that you paid a $15 premium. You will care that you have the metal. Buyers who wait for premiums to fall may wait forever. The premiums are high because supply is exhausted. Supply will not magically reappear. Premiums will stay elevated or go higher. Here are the price levels I'm watching. The first target is $40. This is the psychological round number. When silver breaks $40, it will make headlines. It will attract new buyers. It will create FOMO. The second target is $50. This is the all-time high from 2011. Breaking the all-time high confirms that the bull market is real. It tells the world that silver is not going back to $20. The third target is $100. This sounds crazy if you have not done the research, but if you understand the deficit, if you understand the supply shock, if you understand the monetary crisis, $100 is not crazy. It is inevitable. The only question is timing. I cannot tell you exactly when these prices will hit. Nobody can predict exact timing. But I can tell you the direction. The direction is up. Every fundamental indicator points higher. China's export ban is just the latest confirmation. The path will not be straight. There will be pullbacks. There will be days when silver drops 5% and the bears declare victory. Ignore them. The bears have been wrong for 3 years. They will continue to be wrong until the cycle completes. Now let me talk about the exit strategy. This is crucial. Buying is the easy part. Everyone can buy. Selling is where fortunes are made or lost. Most investors ride a bull market all the way up and then ride it all the way down. They never take profits. They fall in love with the asset. Do not be that investor. Use the gold to silver ratio as your guide. Right now, the ratio is approximately 85 to 1. That means it takes 85 ounces of silver to buy 1 ounce of gold. Historically, this ratio averages around 50 to 1. In extreme bull markets, it has gone as low as 15 to 1. The ratio tells you when silver is cheap relative to gold and when it is expensive. At 85 to 1, silver is extremely cheap. This is the time to hold. When the ratio drops to 60 to 1, silver is getting fairly valued. Keep holding. When the ratio drops to 45 to 1, silver is getting expensive. Start paying attention. When the ratio drops to 30 to 1, consider selling 25% of your silver and converting to gold. You are trading an overvalued asset for an undervalued asset. When the ratio drops to 20 to 1, sell another 25%. When the ratio drops to 15 to 1, that is the signal to exit completely. Convert all silver to gold, or sell for cash and buy real assets like land or rental property. This strategy removes emotion from the equation. You're not trying to pick the exact top. You are using a valuation metric to guide your decisions. It has worked for centuries. It will work this time. Let me talk about the risks. Silver is volatile. It can drop 20% in a week during a bull market. This is normal. If you're leveraged, a 20% drop can wipe you out. Do not use leverage. Do not borrow money to buy silver. Do not margin trade. Buy physical metal with money you can afford to lock up for years. This way, volatility is just noise. You can ignore the daily price moves and focus on the long-term trend. There is also political risk. Governments do not like it when citizens protect themselves from currency debasement. They may implement reporting requirements. They may increase taxes on precious metal sales. In extreme scenarios, they could restrict ownership. These are tail risks. They are unlikely, but possible. Diversify your storage. Keep some at home, keep some in a private vault. Consider keeping some outside the US, if that is feasible for you. Do not put all your eggs in one basket. Here is my prediction for the next 12 months. Silver will trade above $50 before the end of 2026. The deficit cannot be ignored much longer. China's export ban accelerates the timeline. Industrial buyers are panicking. Investment demand is surging. The macro environment favors hard assets. All the stars are aligned. This does not mean the path will be easy. There will be selling waves. There will be bank manipulation. There will be days that test your conviction. But the trend is set. The direction is clear. The only question is whether you are positioned to benefit. Now I need you to do something. Leave a comment below this video telling me your thoughts on China's export ban. Do you think this is the trigger event that sends silver to triple digits? Or do you think I am overstating the impact? I want to hear from you. Your comments help the algorithm. They help this video reach more people. They help build our community at Finance Currency. Also, share this video with someone who needs to see it. Someone who has been curious about silver but has not made a move. Someone who is worried about inflation but does not know how to protect themselves. This information could change their life. Do not keep it to yourself. The window is closing. Every day that passes, more metal leaves the west for the east. Every day that passes, the shortage gets worse. Every day that passes, the opportunity shrinks. China locked the door at midnight. The message is clear. They are not waiting. They are not hoping. They are acting. What are you going to do? This is Finance Currency. I will be watching the markets overnight. I will report back with updates as the situation develops. Subscribe if you have not already. Turn on notifications. And remember, the best time to buy silver was 10 years ago. The second best time is right now. Stay sharp, stay stacked. And I will see you in the next video.